Hello and welcome. Have you ever looked at your payslip, seen that 40% figure, and just felt a bit confused? Well, you are definitely not alone. In this discussion, brought to you by the fantastic team at My Tax Accountant, we're going to break down one of the most misunderstood parts of the UK tax system.
This is such a common question. You get a pay rise, you cross that line, and you think, okay, what now? Am I about to lose a huge chunk of my salary? Don't worry, we've got you covered. Let's get into it.
So here's the game plan. First up, we'll look at what the 40% bracket actually is, the official rules. Then we are going to bust a huge myth that causes a lot of stress. After that, we'll dig into some of the hidden impacts of earning a bit more, and we'll finish up with some really smart strategies to help you stay in control of your finances.
All right, let's dive right in with the basics. We need to get the official numbers straight for the current tax year.
Now here are the official bands. You've got your tax-free personal allowance, then the basic rate, and there it is, the higher rate at 40%. But what's really important here is that these thresholds are frozen until 2028. So as wages go up, more and more of us are getting pulled into these higher bands. It's a thing called fiscal drag.
Okay, this right here is probably the single most important thing to understand. It's a marginal tax rate. That means you only pay 40% on the bit of your income that's actually in that band, not your whole salary. This is so crucial. Let's make this real with an example. Imagine you're earning 60,000 pounds. The tax system doesn't just take one big chunk. Nope. It slices your income up. So the first 12.5 grand or so, tax-free. The next big slice is taxed at 20%. And then, see that last bit? That's the only part that gets hit with the 40% rate.
And that leads us perfectly to the biggest myth out there about the 40% tax bracket, the one that honestly causes the most worry when you're up for a pay rise.
You know the fear, right? If I get this raise, I'll cross the threshold and suddenly my take-home pay will plummet. But the reality, because of that marginal system we just talked about, is so much less scary. You only pay that higher rate on the amount you earn above the line.
But wait, that's actually not the whole picture. There's another really important piece of this puzzle that a lot of people miss, and it actually makes the jump less steep. And that's national insurance. So check this out. This is where it gets really interesting. The moment you start paying 40% income tax, your national insurance rate actually plummets from 12% all the way down to just 2%. So while your income tax rate goes up, your national insurance rate goes down. So what does that actually mean for every extra pound you earn? Well, your total deduction rate goes from 32% to 42%. It's a 10 percentage point jump, not the terrifying 20-point leap you might have imagined. It's a bigger bite, for sure, but maybe not quite as big as you thought. Okay, so the story doesn't just end with your payslip. Crossing that 50,000-pound threshold can trigger a few other surprising financial effects that you really need to be aware of.
For instance, if you get child benefit, you'll start to see it get tapered away because of something called the high-income child benefit charge. You might also lose out on the marriage allowance. And your personal savings allowance, the tax-free interest you can earn, gets cut in half, from 1,000 quid down to 500. These are the little things that can really add up.
And there's another, much sharper trap waiting for people once their income passes the six-figure mark. This one catches so many people by surprise and creates an unbelievably high rate of tax.
Yeah, you're seeing that right. For a specific chunk of your earnings, your effective tax rate can jump to a whopping 60%.
So you're probably thinking, how on earth is that possible? Well, it's a bit of a sneaky one. For every 2 pounds you earn over 100,000, you lose 1 pound of your tax-free personal allowance. So not only are you paying 40% on your extra earnings, you also start paying 40% on income that used to be tax-free. You add those two effects together, and bam, you get that shocking 60% rate. Right. So after hearing all that, what can you actually do about it? Is it all doom and gloom? Absolutely not. The great news is there are plenty of smart, totally legitimate ways to manage your tax and take back some control. And these are some of the best tools in the toolbox. We're talking about things like boosting your pension contributions, using salary sacrifice schemes for things like electric cars, making charitable donations. These things can legally lower your taxable income, potentially pulling you back under a threshold, or even helping you sidestep that nasty 60% trap.
And pensions, well, they are a huge one. It's so effective because it's a real double win. You lower your tax bill today, plus as a higher rate taxpayer, the government basically tops up your contribution with 40% tax relief. So you're saving for your future and cutting your tax bill right now.
So it all boils down to this question, doesn't it? Are you in the driver's seat when it comes to your tax plan? Just knowing these rules and strategies is the massive first step. It's about shifting from just reacting to your tax bill to actually planning for it proactively.
Of course, everyone's situation is unique. Maybe you have bonuses, or investments, or rental income. It can all get complicated. For that kind of personalized advice that's tailored exactly to you, it's always a really good idea to speak with an expert, like the folks over at My Tax Accountant.